Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Now I'm going to start the last topic of this Income Tax Act 1961, that is income from other sources. Income under the head income from other sources. Already I have completed the 4 topics: income from salary, income from house property, profits and gains of business and profession, capital gain. These 4 heads already I have completed in the previous videos. Now in this video I am going to explain you in detail regarding what are the incomes that are taxable under the head income from other sources. So if you have already watched the earlier videos, you might have got a good command on the subject of Income Tax 1. I have explained the complete detail regarding Introduction to Income Tax Act 1961 in the earlier videos. So I suggest you, if you have not watched that video, go to the playlist, select the subject Income Tax 1 for the assessment year 2021. Select the topic Introduction. Watch the complete video. Definitely you will get a lot of knowledge. You will get the confidence on the subject. So I have explained in detail regarding the taxability under the Income Tax Act. So what are the basic concept, residential status, and different types of SSCs, basic concepts, all these things I have explained in detail. Income from salary, so many problems we have solved. Now I'm going to start income from other sources. So if you want the complete command on this subject, follow my suggestion. Watch the video till the end. Don't skip in between and don't join in between. So if you watch the videos in rhythm, first part, second part, third part, definitely you can be able to get a lot of command. Otherwise, if you join in between, you will not be able to understand. I have uploaded the problems in the link under my description. So whenever you are following the problems, I suggest you to take a printout of the problems, which I have given in the link, and keep it ready before watching the problems. That will benefit you. Now, income from other sources. This is the residual head of income. Any income which does not fall in the first 4 heads will be put to tax under income from other sources. The Income Tax Act says, first of all, an SSC has to check whether his income falls under income from salary or house property or profits and gains of business and profession or capital gain. If it's fall into the specific head, then you have to put it taxable under that head only. If an income does not fall under the head income from salary, house property, profits and gains or last capital gain, then only it will be put under income from other sources. So what is the test we have to apply? First of all, for income from salary, there should be employer-employee relationship, master-servant relationship between the payer and the receiver. If there is employer-employee relationship, then only it will be treated as income from salary. Example, if a person is a lecturer in a college, he is getting salary from the college. So that salary is taxable under income from salary, because there is employer-employee relationship between the college and the lecturer. There is employer-employee relationship. Salary received is taxable. Sometimes a lecturer will be a part-time lecturer in a college, in which there is no agreement for employment. There is agreement for a contract to complete the subject. In that case, there is a contractor and contractee relationship. In that case, the remuneration received is not taxable under income from salary. It is taxable under income from other sources. Similarly, the salary received by MPs and MLAs, that is taxable. It is salary, but it is not taxable under the head is salary. It is taxable under income from other sources, because there is no employer-employee relationship between the payer and the receiver of salary. Like this, Income Tax Act says we have to check, we have to test whether it comes under salary or not. Similarly, income from house property. If a person is the owner of the property and let out the property on rent, the rent received by the owner of the property is taxable under income from house property. Similarly, profits and gains. If a person runs a business or carry on his profession, then income earned from the business or profession carried on, that will be taxable under the PGBP, profits and gains of business and profession. Last one, capital gain. If an assessee transfers a capital asset during the previous year and gain arised on transfer of capital asset. That is taxable under the income from capital gain. So specifically we have to test whether the income falls in the first four categories or not. If it does not fall in the first four category, it will be taxable under income from other sources. So it is the open head. Open head का मतलब any income may come under this head, residual head. So here we are going to study what are the items that may come under this head. We cannot give exclusive list of all the items which are taxable under income from other sources because it is unlimited. It is open head. Any income may come within this income from other sources. So we'll take a few examples. We'll take few examples of incomes which are taxable under the head income from other sources. Now see, some of the important items which are included under the head income from other sources. What are the example of items? First one, interest on securities. Securities means the bonds issued by government or debentures issued by companies. The bonds and debentures are called securities. A person may invest his money in purchasing the security. He may purchase the bonds of the government or debentures of the company on which he will receive interest. That is called interest on securities. That will be taken under income from other sources. I'll explain you in detail. We'll solve the problems on interest on securities. Secondly, dividend on shares. Dividend on shares. According to the Income Tax Act 1961, dividend received from Indian companies are exempted from tax. Dividend received from foreign companies are fully taxable. Indian companies, there is a limit of 10 lakh rupees. Over 10 lakh rupees, it is taxable at a flat rate of 10%. But below 10 lakh rupees, dividend income is exempted. Over 10 lakh rupees, taxable. Whereas foreign company dividend, it is fully taxable. Then interest on debentures issued by cooperative societies. If debentures are issued by cooperative societies, interest received thereon taxable. Then dividend on shares of cooperative societies. Next one, interest on bank deposit. If a person deposits some amount in the bank and he receives interest on bank deposit, that is taxable under income from other sources. Casual income. Casual income is an income which is received by an element of chance. Luckily, he will get some unexpected amount. He will get. That is called casual income. Examples of casual incomes are winning from lottery, winning from horse races, winning from card games, winning from gambling, betting. All these things will come under casual income, and casual income is taxable under income from other sources. Separate provisions are there. In the earlier videos, I have explained you in detail what is the taxability of casual incomes. But right now, remember, casual income is a part which comes under income from other sources. Rent or hire charges received by letting of plant, machinery or furniture. Sometimes an SSC will let out, give on rent, plant, machinery or furniture. If it is his business to give that on rent, plant, machinery or furniture, it's a business income. But it is not his business. Suppose a person, it is not his business to let out on hire furniture. But sometimes casually he will let out his furniture and receive some rent. In that case, the rent received or hire charges received of plant, machinery or furniture is taxable under income from other sources. Next, rent from subletting the house. If a tenant has sublet the house, then rent received from subletting is taxable under income from other sources. Then direct royalty received. If a person receives royalty or director's fees, examination remuneration received by a teacher. A lecturer, a professor or a teacher will give a number of services to the employer apart from teaching. Apart from teaching, he will make the question papers, he will evaluate the answer sheets, he will invigilate the examination hall. Like this, different services a teacher may give. In that case, he will get extra remuneration. The extra remuneration which a teacher gets apart from salary is taxable under the head income from other sources. Next comes agriculture income from foreign land. In the earlier videos, previous videos, I explained you agricultural income in India is exempted, provided some conditions are satisfied. But agricultural income from foreign country received in India is fully taxable under income from other sources. Rent from land, rent from open land. There is no structure, there is no building. If rent of building is there, it will be taxable under income from house property. But open land, if it is let out, rent received is taxable under the head income from other sources. Commission received, like insurance agents will receive commission or any other person may receive commission, it is taxable. Interest on security issued by foreign country, foreign governments, it is taxable. Remuneration received by MPs and MLAs, just now I told you. In real terms, it will be said as salary of MP, salary of MLA. But that salary of MP, MLA is not taxable under salary head. It is taxable under income from other sources because there is no employer-employee relationship. Next, interest on loan given. If a person has given a loan to any other person and receives the interest, it is taxable under income from other sources. Then interest on income tax refund. Sometimes a person has paid more income tax. So after making the assessment, income tax department will refund the excess income tax paid. That is called refund of income tax. So if there is a delay in refund of income tax, then income tax department will give interest on income tax refund. That interest is taxable under income from other sources. Then gift received on or after 1/10/2009 either in cash or in kind in excess of the limit. One limit is given. Beyond that limit, if gift is received either in cash or in kind after 1/4/2009, it is taxable under income from other sources. Forfeited advance money received for sale of capital asset on or after 1/4/2014. In the last video, I have explained this. If a person has transferred capital asset, and for the purpose of making the transfer, he has received some advance money, but the buyer has not, fulfilled his obligation to purchase the property. Then the advance money is forfeited. So, in a contract of sale, if advance money is received by the seller, later on the buyer has negatived the transaction, the advance money received will not be refunded. It will be forfeited according to the agreement. So, if advance money is forfeited after 1/4/2014, then it will be taxable under income from other sources. So these are few examples I've explained. Don't think that these are the only items which comes under income from other sources. Any income will come. So here only few examples I've given. These are the examples of income which are taxable under that income from other sources. Now, the whole income from other sources chapter we divide into two parts. The first part, interest on securities. The first part is interest on securities. The second part is other income other than interest on security. Because Income Tax Act has given specific procedure of how to compute, calculate interest on securities. I told you securities means the bonds issued by the government or debentures issued by the companies. These are called securities. So if a person, SSC, has invested in securities, on that investment he is getting interest on security, then it will be taxable under the income from other sources. From the income tax point of view, all the securities are divided into three categories. Exempted securities, exempted from tax, tax-free securities, and less tax security. Separate provisions are there in Income Tax Act regarding taxability of these securities. So I am briefly explaining each one. First of all, securities exempted from tax means those securities on which interest is completely exempted, not at all included in the income of the SSC. The SSC has invested in those securities which are exempted. The Income Tax Act has given the list of the securities that if the SSC has invested in these securities, the interest received thereon is completely exempted. Now, while doing the problem, you have to see whether this security is exempted or not. If it is exempted, it should not be taken. Interest should not be calculated, only a note should be given that this security is exempted from tax, so interest is not calculated. That is the point. Now what are the examples? Again, examples I have taken, I have not taken the complete list of security. The important securities which will come in the problems. So you have to keep it in mind. First one, 12-year National Plan Saving Annuity Certificate. Second, Treasury Saving Deposit Certificate. Post Office Cash Certificate. National Plan Certificate. Post Office National Saving Certificate. Post Office Saving Bank Deposit Account. Post Office Cumulative Time Deposit. NRI Bonds 1988 issued by SBI. Or 10.5% tax-free bonds issued by HUDCO. Or 9.25% tax-free bonds issued by Rural Electrification Corporation. Or 10.5% tax-free bonds issued by National Hydroelectric Power Corporation Limited. Or tax-free Ahmedabad Municipal Corporation bonds and Nagpur Municipal Corporation bonds. So remember, these are the securities on which interest is not taxable. Now, second category of securities are tax-free securities. Tax-free securities are those securities on which the tax will be paid by the issuing authority. Whoever issues the security, themselves they will pay the tax. This security may be issued either by the government or by the commercial organization, commercial companies. Government may issue or companies may issue. Which security? Tax-free. In that case, the issuing authority may be government or the issuing authority may be a company. Suppose a company issues tax-free securities. In that case, the tax on the interest of those securities will be paid by company itself. The company is paying the tax on behalf of the security holder. A government, suppose government issues tax-free security, then the government will pay the tax. The issuing authority will pay the tax. That's why it is called tax-free securities. And the tax payable by the holder of this security is paid by the security issuing authority. Now, tax-free government security. Now, in the problem, while doing the problem, you have to see whether it is exempted from tax security or tax-free security or less tax security. If it is exempted from tax security, this one, simply you have to give a note that it is exempted from tax security, so interest is not considered. If it is a tax-free security, then you have to see whether it is a tax-free government security or tax-free commercial security. That you have to find it, because the method of calculating the interest is different. Method of calculating interest is different. First of all, tax-free government security. If you find in the problem it's a tax-free government security, then gross interest is equal to face value into rate by 100. This formula we applied to find out the gross interest. Face value into rate by 100. Suppose if it's a tax-free commercial security, then in 2 steps you have to calculate gross interest. Step number 1, calculating the net interest NI. The net interest is equal to face value into rate by 100. Face value into rate by 100, you will get the net interest. Now you have to gross it up. Second step, gross interest. Gross interest is equal to net interest into 100 by 90. Net interest into 100 by 90, because 10% is the rate of TDS. Tax deducted at source is 10%. So that's why 100 by 90. So these 2 steps, first step calculating the net interest, second step calculating the gross interest. These 2 steps will be applied when the tax-free commercial security is there. Tax-free commercial. Tax-free government security, only in 1 step. Gross interest is equal to face value into rate by 100. If it's a commercial security, 2 step. First calculate net interest, second calculate gross interest. Net interest is equal to face value into rate by 100. Gross interest is equal to net interest into 100 by 90. That's all. Now last one is less tax security. Third category of security is less tax security. In the less tax security are those security, the tax will be deducted from the interest and tax will be paid by the issuing authority. So complete interest will not be paid to the security holder. From that interest, deduct the TDS and pay the net amount to the security holder. Security holder. Example, you are the security holder, you are holding 1 lakh rupees of security, 10% is the interest. Rate of interest 10%. 1 lakh rupees is the face value. So 10% of 1 lakh, 10,000. So company will not pay whole 10,000 to you. From 10,000 rupees, deduct TDS. TDS will be suppose 1,000. So out of 10,000 rupees, 1,000 rupees will be deducted and 9,000 rupees will be paid to the security holder. That 1,000 rupees deducted, that is called TDS, and that will be paid by the issuing authority to the income tax department. Less tax security. In this case, this less tax security may be issued either by the government or it may be issued by the commercial companies. So whether it is government security or commercial security, if it is a less tax security, only one step, gross interest is equal to face value into rate by 100. Face value into rate by 100. So simple formula will apply to calculate gross interest. Now deductions. After calculating all the interest on security, deductions are allowed under section 57 by the Income Tax Act. Deductions under section 57. Two deductions, only two deductions are allowed. The first deduction is collection charges. So Income Tax Act says if collection charges are incurred, by the SSC in collecting the interest, that collection charges will be allowed as deduction. First one. Second one, interest on loan taken to purchase the security. Sometimes the SSC has taken a loan to pay to invest in security. For example, I have taken a loan from bank 1 lakh rupees at a rate of interest of 10%. So at 10% rate of interest, I have taken a loan from bank, and that loan, that 1 lakh rupees loan which I have taken, I have invested that in security of the company. I have purchased some bonds, purchased some debentures of XYZ company, on which the rate of interest is 15%. So I am getting 15% interest on my investment in debentures. Whereas the 1 lakh rupees I have taken a loan from bank to make the investment, I am paying the interest. So I am the investor, I am getting the interest, I am paying the interest. I am getting the interest on my investment, whereas I am paying the interest on the loan taken to purchase the security. So Income Tax Act says that interest paid on loan taken to purchase the security will be allowed as deduction. The actual interest paid is allowed as deduction. If interest is paid to buy exempted security, no deduction is allowed. Income Tax Act says if a person has taken a loan to purchase exempted securities, these are the exempted security. To purchase this exempted security, he has taken a loan. Then Income Tax Act says interest paid will not be allowed as deduction. Next one is interest paid will be allowed as deduction even if interest is not received on those security. One more new point. Income Tax Act says interest paid on loan taken will be allowed as deduction even if an SSC has not received the interest on that investment. He has not received the interest on investment, but still interest paid on loan will be allowed as deduction. Now, commission or brokerage paid to purchase or sell the security will not be allowed as deduction. This point you have to remember while doing the problem. In the problem it will be given commission or brokerage paid by the SSC to purchase or sell the security. That brokerage or commission paid not allowed as deduction. Only two deductions are allowed, that is collection charges and interest paid on loan taken to purchase the security. That's it. So we have completed up to security part. So I have explained you what are the items that may come under income from other sources. I have explained you about interest on securities. So now I am discussing about the format of how to compute the income from interest on securities. This is the format you can see. Computation of income from interest on security of Mr. So-and-so. Then for the assessment year 2021. Two columns will open at the extreme right hand side, inner column, outer column. Interest on tax-free government securities. Interest on tax-free commercial securities. We divide all the securities into government security and commercial security. So first we take tax-free. Tax-free government security, tax-free commercial security, then less tax. Again less tax we have government as well as commercial. So less tax government security and less tax commercial security. When we have taken all the gross interest of all the securities, the total income, the total gross income from interest on security. Gross income from interest on security. From this, deductions are allowed under section 57. The deductions are collection charges and interest on loan taken to purchase the security. Only two deductions are allowed. Suppose if brokerage paid or commission paid to purchase or the sell the security, deduction will not be allowed. Only two deductions are specified by the Income Tax Act. Then we'll get income from interest on securities. Now one concept will be asked in theory question. What do you mean by bond washing transactions? Bond washing transaction means it's an act of selling the security just before the year end. Before the financial year ends, the SSC will sell the security, and immediately after the closing of the financial accounts, then next year again he will repurchase. That means sell and repurchase the security in order to avoid the tax. In order to avoid the tax. For example, Mr. X, he is in high income bracket tax. High income bracket. Now in order to reduce his tax liability, what he will resort is, just before the due date, before the year end, he transfer his security to another person who is having no income or very low income. Then just to avoid the tax, he is transferring. After the year ends, again he will take back that security and transfer in his own name. This is called bond washing transaction. Why this act will be done? To reduce his tax liability, to avoid the tax. So if the Income Tax Act happens to know this act, then definitely Income Tax Act will make the person who transfer the security as a deemed owner, and he will be put to tax. That will be asked in theory question. Now, dividend on shares. See here, the whole income from other sources we have divided into two parts. The first part, interest from securities. The first part is income from interest on securities. The second part is all other incomes. So all other incomes will take the first, dividend on shares. This is the most commonly found income. So dividend means the part of the profit of the company which is distributed among shareholders. When a person purchases the shares, he will become a shareholder. He will get the part profit from the company, that is called dividend. The Income Tax Act has given specific provisions regarding dividend income. How much it is taxable, when it is taxable. So for the purpose of taxability, all the dividends are classified into three categories. First of all, dividend declared by domestic company or Indian company. Dividends which are declared by domestic or Indian company, first category. Second category, dividend or any other income declared by mutual funds. In India, the biggest mutual fund company is UTI. So UTI or any other mutual fund, if dividend or any other income is declared. Thirdly, dividend declared by a foreign company. In this way, we classify the dividend into three categories. One by one, we'll study. Dividend received on preference shares or equity shares from Indian company is exempt from tax under section 10 subsection 34. Specifically, Income Tax Act given the provision that any dividend received, either preference dividend or equity dividend from Indian company or domestic company, is exempted under section 10 subsection 34. Now, however, under section 115 BBDA, if aggregate dividend received by a person from domestic company exceeds 10 lakh, then the excess amount is taxable at 10% plus surcharge plus health and education cess. Now a new section is inserted by Income Tax Act. It says, if a person gets the dividend income more than 10 lakh in a previous year, in a particular year, if the aggregate of all the dividend received from different Indian companies, aggregate income from dividend exceeds 10 lakh rupees, then the excess will be taxable. Over 10 lakh rupees, it will be taxable at a flat rate of 10% plus education cess and health plus surcharge and education cess. This is regarding dividend declared by Indian companies. Now second, dividend declared by UTI or other mutual fund, it is fully exempted from tax. So when in the problem, if this point comes, dividend declared by UTI, Unit Trust of India, that is the biggest mutual fund company in India, and other mutual funds, if any dividend or any income is declared by this mutual fund, fully exempted. Now dividend received from a foreign company, if a person SSC receives dividend from a foreign company, then Income Tax Act says net dividend received is taxable. No deduction will be allowed on interest on loan taken to purchase the security. For example, Mr. X, he has taken a loan of 10 lakh rupees from a bank. Why he has taken 10 lakh rupees loan? To purchase foreign income security, foreign company security. To purchase foreign company security. In that case, interest paid on loan taken to purchase that security will not be allowed as deduction. So these are the provisions regarding dividend. Now next income is letting of plant, machinery and furniture. Sometimes an SSC will give on hire or give on rent plant, machinery or furniture and receives the hire charges. That is taxable under income from other sources, provided it should not be his business activity. If the letting of plant, furniture or of machinery, it is its business activity, then the income will be treated as business income, not income from other sources. Now deductions will be allowed. When a person is receiving the rent or hire charges by letting out furniture or machinery or plant, he may incur some expenditure. The income tax rule is, if any expenditure is incurred to earn the income, that expenditure will be allowed as deduction. So what are the deductions allowed? Repairs, insurance premium, depreciation on any other expense incurred to earn the income. So Income Tax Act says that whether expenditure is related to this income or not. If the expenditure is related to this income, then expenditure will be allowed as deduction. All these points will come across while doing the problem in the next video. Next, family pension. Pension means the amount which is received after salary ceases to exist. That means after retirement. As long as the employee is in service, he will receive salary. After retirement, the person will get pension. So Income Tax Act says salary or pension, both are taxable under income from salary. Salary as well as pension, both are taxable under the head income from salary. But sometimes there is a provision that the employer will pay family pension. Family pension means the pension which is received by the legal representative of the deceased employee. Legal representative of the deceased employee. Example, Mr. X is working in government department. He retired from the service. After retirement, the government is paying pension to him. Pension to Mr. X. So Mr. X is getting pension, it will be taxable in his salary income. Later on, Mr. X expired. Death of Mr. X. So according to the rules and regulations of the agreement, the government is giving the pension to Mrs. X, wife of Mr. X. The pension received by the wife of Mr. X is called family pension. Now Mrs. X is getting family pension. Income Tax Act says it is taxable in the hands of Mrs. X under the head income from other sources. It is taxable. But one deduction will be given under section 57(2)(a). Section 57(2)(a), deduction will be given, which is least of the following two amounts. 1/3 of pension received or fixed amount of 15,000. Whichever is least, that will be allowed as deduction from pension, family pension. That is the rule regarding family pension. Now, gift received. A number of provisions are given under Income Tax Act regarding gift. So the main points I am discussing here, many more points will come across while doing the problem. Gift received either in cash or in kind up to 50,000 is exempted from tax. If the value is more than 50,000, then the total value of gift becomes taxable. See here, Income Tax Act says any gift received in kind, cash or kind, up to 50,000 rupees is exempted. If a person receives the gift over 50,000, then the entire amount is taxable without any exemption. For example, if a person receives 49,000 rupees gift, exempted. If a person received 99,000 gift, 99,000 rupees gift, the entire 99,000 will be taxable. Don't think that out of 99,000, 50,000 is exempted, remaining is taxable. No, the complete 99,000 will be taxable. That is the first provision. Second, cash or property received as gift on the occasion of marriage of the SSC is fully exempted. Many a times, the SSC at the time of marriage, he is getting some gift. So all the gift received on the occasion of marriage is completely exempted. Similarly, gift received from a relative is fully exempted. Income Tax Act says if a gift is received from a relative, who is a relative? Income Tax Act has given a list of the persons who are called relative. Example, spouse is their son or brother or sister, mother, father, all these will come under relatives. The list is given. If the gift is received from those relatives, it is fully exempted from tax. Next is cash or property received in gift under a will or inheritance is fully exempted. So any gift received either in cash form or in kind form, according to the will of the person or according to inheritance, it is fully exempted. So these are the few points you have to remember regarding gift. Now, winning from lottery. Winning from lottery is a casual income. It is taxable under the head income from other sources. So winning from lottery examples, casual income examples, winning from lottery, crossword puzzles, horse races, gambling, betting, all these things will come under casual income. So winning from lottery is also one of the casual income. It is taxable. It is taxed at a flat rate of 30% plus surcharge plus education cess. Education cess is compulsory. Health and education cess is compulsory, whereas surcharge depend on the total income. Already we have discussed in the previous videos. So if the winning from lottery is 10,000, more than 10,000, then the received amount is the net amount. It should be grossed up. If in the problem it is given winning from lottery received amount is given, that received amount is the net amount. We have to gross it up. How to gross up? Net winning from lottery into 100 by 70. 100 by 70 because the TDS is 30% on winning from lottery. So these are few provisions I've explained on income from other sources. Many provisions are there, but for your level of examination, this much provisions, if you remember, that will do for writing best in the examination. So in the next video, I'll start the problems on income from other sources. So hope you are satisfied with my lecture. If you are satisfied, please give the comments on these lectures. I want the feedback from the students regarding how they view about these lectures. Share this channel in your group, in your friend circle, so that more students can watch these videos and enhance their knowledge. And don't forget to subscribe my channel if you have not yet subscribed. I suggest you to visit the playlist for other subjects videos. So many subjects I have uploaded, like financial accounting, advanced accounting, cost accounting, managerial accounting, corporate accounting, income tax, and apart from that, business statistics, financial management, investment management. So many videos I have uploaded. So select your subject, select the video, select the topic, and increase your knowledge. So we'll continue the problems in the next video.